The poverty tax. Last year, American banks collected $7.7 billion in overdraft fees. Not from reckless spenders. Not from people who didn't read the fine print. From people who were already running out. Think about what that number means. The same financial system that offers free accounts, preferential rates, and personal wealth management to people who don't need help, charges the people least able to pay for the privilege of temporarily having nothing. This is not a design flaw. It is the design. There is a theory that explains this more clearly than any economics textbook. It comes from a novel, a fantasy novel of all places. In Terry Pratchett's Men-at-Arms, a character named Sam Vimes, a policeman who grew up poor and became wealthy, reflects on an insight he first understood when he had nothing. He called it the Boots theory of socioeconomic unfairness. The theory is this. A wealthy man buys a pair of $50 leather boots, quality stitching, good materials. Those boots last him 10 years. A poor man cannot afford $50. He has $10. He buys the cheap boots, but the cheap boots fall apart after one season. Next year, another $10. The year after, another $10. Over 10 years, the poor man has spent $100 on boots. Double what the rich man spent. And his feet are still wet. This is not a metaphor. This is the foundational equation of financial inequality, and it is running inside your life right now in ways you haven't yet named. Consider something as ordinary as toilet paper. If you have $50 available, you buy the bulk pack. Cost per roll, 50 cents. You are stocked for 3 months. If you have $4, you buy the 4-pack from the corner store. Cost per roll, $1.50. You are paying 3 times more for the identical product, simply because you could not afford the upfront price. Toilet paper, laundry detergent, diapers, paper towels, cooking oil, every non-perishable good in your household. Economists call this the poverty premium. And it means that if you are financially constrained, your personal inflation rate is structurally higher than a wealthy person's, not because of your choices, because of your capital position. Now here is the part that changes how you see the companies selling you these products. This is not an accident of the market. Bulk pricing exists because companies can charge more per unit to customers who cannot afford to buy in volume. The corner store charges more per roll of paper towels than Costco, not because it costs more to stock them, but because the customer at the corner store cannot access the lower price. They have no leverage, no capital, no alternative. The poverty premium emerged through competitive market forces as a feature because it is profitable. The payday lenders, the rent-to-own retailers, the buy here, pay here dealerships, the overdraft fee banks, they do not want you to calculate what you're actually paying. Because the moment you calculate it, you become a threat to their business model. Let's talk about banks specifically, because this is where the poverty premium becomes legally permitted extraction. If you have $10,000 in your checking account, the bank pays you interest. Small, but the relationship is, they hold your money, they profit from it, they compensate you for the privilege. If you have $20 in your account, and a forgotten subscription charges $25, you are negative $5. The bank does not cover you. The bank charges you $35 in overdraft fees. Run the math. You borrowed $5 for less than 24 hours. It cost you $35. That is an annual percentage rate, point of 700%. If a street lender charged 700% APR, they would face federal criminal prosecution. When a bank does it, it appears on your statement as a service fee. And last year, those service fees generated $7.7 billion, extracted almost entirely from accounts carrying less than $1,000. The rich receive interest. The poor pay interest to the same institution. Here is what makes this system more devastating than just mathematics. When you are genuinely worried about money, not mildly concerned, not theoretically stressed, but actually uncertain whether you can cover rent next week, something measurable happens to your cognition. Researchers at Harvard and Princeton published a study in the journal Science. Financial scarcity, the lived experience of not having enough, reduces measurable cognitive function by the equivalent of 13 IQ points. 13 points. That is the same cognitive impairment as missing an entire night of sleep. Your brain, under genuine financial pressure, physically loses the capacity to make long-term strategic decisions because it is entirely occupied with immediate survival. This is why people in financial distress make decisions that look irrational from the outside. They take the payday loan at 400% interest. They can't engage with a budget. They know the math is wrong, and they take the deal anyway. They are not irrational. They are cognitively impaired by a stress state the system created and depends on to continue functioning. The Boots theory is not just about money. It is about cognitive bandwidth. The wealthy man doesn't just save $50 on boots. He saves 10 years of mental energy spent worrying about wet feet. That mental energy compounds into better decisions, more focus, higher productivity, greater risk tolerance. The financially constrained person is running that same mental processor at maximum load just to survive the week. Now let's talk about cars. In most of the United States, a car is not a lifestyle choice. It is infrastructure. You need a car to get to work to earn the money you need to survive. A financially secure person buys a 3-year-old reliable vehicle, $18,000. They pay cash or secure a 4% loan. Routine maintenance for 10 years. Total cost of ownership, roughly $25,000. Now watch what happens to someone with damaged credit and no savings. They walk onto a buy here, pay here lot. The car is worth $4,000. They're charged $8,000 because they have no alternative. The interest rate on the financing, 24%. Over the life of that loan, they pay $15,000 for a car worth $4,000. And here is the part that closes the trap. Statistically, the car breaks down before the loan is repaid. They are still making monthly payments on a dead vehicle while trying to finance a replacement. They are not paying for a car. They are paying a risk premium, imposed by lenders who have calculated exactly how much they can extract from a person with no alternatives. And the only way to stop paying the risk premium is to have enough capital to be considered low risk, which you cannot accumulate because you are spending your capital paying the premium. Step back for a moment, because there is a pattern running through everything we have covered. The bulk pricing gap, the 700% overdraft APR, the buy here, pay here loan, the payday lender. They are all variations of a single mechanism. The system charges you a penalty for being financially constrained. And the only way to stop paying the penalty is to hold capital, which you cannot accumulate because you are paying the penalty. It is circular. Intentionally so. The poverty trap is not a series of bad decisions stacked on top of each other. It is a closed loop, engineered through financial products, market structures, and policy choices that requires external force to break. Not discipline, not willpower. Capital. Housing is where the loop becomes permanent. When you rent, you pay 100% interest on your shelter. Every dollar you pay builds equity for someone else. You are funding your landlord's mortgage, plus a profit margin, every month, indefinitely. To escape renting, you need a down payment, $20,000, $30,000 in many markets. If you are paying 50% of your income in rent because the rental market has been systematically repriced by institutional investors and private equity firms buying residential properties at scale, you cannot save the down payment. You are trapped paying $2,000 a month for a property the owner holds for $1,200 a month. The wealthy person buys the house, lowers their monthly overhead, and acquires an asset that appreciates over time. The financially constrained person pays more every month for an asset they will never own, that becomes more expensive every year they cannot buy it. You are not renting an apartment. You are renting your entire financial existence. There is one dimension of the poverty tax that almost never enters the conversation. Time. If you own a washer and dryer, laundry takes 5 minutes of active work. Load it, walk away. If you don't, you travel to the laundromat, you wait, you travel back, 2 hours, every week, plus the cost of the machines, plus the travel. 100 hours per year, spent on a task that a $600 washing machine would eliminate. But the washing machine requires capital you don't have, so you pay in time instead. In low-income neighborhoods, the full-price supermarket is often miles away, accessible only by car or a 90-minute bus round trip. What is accessible is the convenience store, with prices 40% higher on everything you need. The geography of poverty is not accidental. Supermarkets open where demographics project profitable margins. They close in communities that cannot sustain them. Entire zip codes are left without access to competitive food pricing. Not by design exactly, but the outcome is the same. Poverty steals money, and poverty steals time, both of which you have less of. Here is something the financial industry does not want you to calculate. Companies do not just tolerate the poverty tax. They budget for it. Banks project overdraft fee revenue in their annual financial models. Payday lenders build their entire business case on repeat customers, because a borrower who takes one loan and repays it is not profitable. The profitable customer is the one who rolls the loan over and over, paying fees each time. Buy here, pay here dealerships model default rates and price vehicles accordingly. The expected defaults are not a risk. They are priced in. The vehicle gets repossessed, returned to the lot, and sold again. The poverty premium is a revenue line. Planned, modeled, optimized, reported to shareholders. Which means, when you pay a late fee, someone received a performance bonus for designing the system that generated it. This is not paranoia. This is how the quarterly earnings call works. So, how does the loop break? Not with better habits, not with financial literacy seminars, not with the advice to stop buying lattes and cancel Netflix, as if $12 a month is going to dismantle a structural premium that operates on every dollar you spend. It breaks with a buffer. The first $1,000 held in a savings account is the most powerful money you will ever hold, not because of what it earns, because of what it stops. With $1,000 in reserve, a flat tire is an inconvenience. Without it, a flat tire triggers a payday loan. The payday loan charges fees that reduce next month's budget. The reduced budget creates the conditions for the next crisis, which triggers another loan. The cascade. One shock, generating the next, in a chain that compounds faster than any income can outrun it. The buffer breaks the cascade. It converts financial emergencies into financial annoyances. In the cascade, that relentless chain reaction is the engine of the poverty trap. Stop the cascade, and the entire machine slows down. The mindset shift that accelerates this is specific. Stop asking, "Can I afford the monthly payment?" Start asking, "What is the total cost of ownership?" The buy here, pay here lot wants you focused on the $250 monthly payment, not the $15,000 total cost of a $4,000 car. The credit card company wants you focused on the minimum payment, not the 8 years it will take to clear the balance at that rate. The system profits from the gap between the monthly number and the lifetime number. Close that gap by doing the arithmetic the system hopes you won't do, and you stop funding the premium. You become, in their revenue model, a bad customer. Which means you are winning. One more dimension, because this is Risk Engine, and we do not stop at the present. The poverty tax is about to get significantly worse. AI and automation are projected to eliminate or restructure 30 to 40% of current jobs within the next 15 years. The roles at highest risk are not the highest paid positions. They are the roles held by people with the least financial buffer: retail, food service, administrative processing, transportation, entry-level logistics. When those incomes disappear, the people with no reserve face the cascade immediately. No buffer, no runway, no time to retrain. The people with capital absorb the disruption, reposition, wait out the market shift. The poverty tax compounds under economic disruption. The premium gets higher precisely when the ability to pay it gets lower, which means the window to build the buffer is not open indefinitely. The cost of waiting is the same as the cost of ignoring the check engine light. Risk engine analysis. The first insight: being broke is not a behavior problem. It is a capital problem. The system charges you more for having less at every point of contact: groceries, banking, transport, housing, time. The solution is not to change your behavior within the premium pricing tier. It is to acquire enough capital to exit it. The second insight: the poverty tax is a revenue model, not an accident. Banks, lenders, retailers, and landlords generate planned income from the premium they charge financially constrained customers. Your financial distress is someone else's revenue line. Understanding this shifts the emotional response from shame to strategic resistance. The third insight: cognitive impairment under financial stress is documented and measurable. The 13-point reduction in functional IQ under scarcity conditions means the people most in need of sound financial decisions are the people least cognitively equipped to make them. because the stress itself is degrading the faculty they need. The exit from this state requires structural protection, not willpower. The fourth insight: time is the hidden currency of the poverty tax. The laundromat, the food desert, the bus route to the supermarket. These are not lifestyle inconveniences. They are hours extracted from productive and restorative time by systems that benefit from your continued financial fragility. Every hour stolen by poverty is an hour unavailable for skill building, rest, or income growth. The fifth insight: the buffer is not savings, it is armor. The first $1,000 in an emergency reserve does not generate meaningful interest. What it generates is immunity to the cascade, the chain reaction where one financial shock triggers a loan, which reduces next month's margin, which creates the next shock. The buffer converts emergencies into annoyances and buys the cognitive space to stop reacting and start building. Without it, you are always one check engine light away from a $2,500 crisis. There is a version of this story where the math runs differently, where the $300 repair gets made in February before the transmission fails in April, where the bulk toilet paper gets bought because there was $50 available to buy it, where the bank account had $400, so the overdraft fee never triggered. That version requires one thing: not discipline, not financial literacy, not anything the system sells to people who don't need it. It requires a buffer. A small, deliberately built gap between your income and your obligations that converts financial emergencies into financial annoyances and breaks the cascade before it builds. The poverty tax is a system, and the only exit from a system is to change your position within it. One buffer, one paid down loan, one bulk purchase. One pair of boots that lasts 10 years. The system charges you more for having less. Stop paying. Risk engine. We map the systems others pretend don't exist.